Hello and welcome back to TaxCrunch. My name is Christopher Volas, and today's video concerns a question I frequently get from small business owners. Now that I'm an S corporation, how do I pay myself? And the reason this question pops up is that as a sole proprietor, you don't have payroll, you pay yourself as you receive profits, and that's how you distribute money to yourself. Now that you've incorporated and you're an S corporation, if you work for the company, you're now required to put yourself on payroll for a reasonable compensation. Now, reasonable compensation is subject to interpretation, and it's a gray area with the IRS and the taxpayers. And I'm gonna have a separate video just on the reasonable compensation.
Show me the money.
So some accountants use a percentage as a rule of thumb. For instance, they may use 50% of the profits and issue that amount as wages. This can become problematic because your effort and expertise may not correspond to that percentage. So let's do an example. If you're a web designer and typically on the open market, you could demand a salary of $70,000 per year. If you go out and open your own business and you make profits of $200,000, 50% rule of thumb is going to give you a $100,000 salary. Now, you don't need to pay yourself more than a reasonable compensation because all you're doing is paying additional payroll taxes. So for the purposes of our discussion, sometimes you will want a higher salary. For instance, if you want to take advantage of a retirement plan and fund it fully, you're going to want a higher salary to get that profit sharing percentage in there. But for our discussion, let's assume we're trying to keep the payroll as low as possible to keep those payroll taxes down. So why does the question pop up? Simply because oftentimes the S Corp owner takes a salary for an amount lower than what they need to take as distributions from the business. So the common misperception is, if I take money from my S Corp, am I taxed on it? And that's not true. You're going to be taxed on your profits, regardless of whether you take the money out of the business or not. So back to our web designer example, if he makes $200,000 in profits, he is going to pay income tax on $200,000. However he slices up the payroll is going to determine the payroll taxes. So if he gives himself a payroll of $50,000, he'll pay payroll taxes on $50,000, and he'll pay income tax on the full $200,000. If he pays himself a salary of $100,000, he'll pay payroll taxes on $100,000 and pay income tax on the full $200,000. So you can see it does not affect your income tax. The salary and the games with the S corporation is simply for payroll taxes. And that reasonable compensation the IRS requires is simply to get enough payroll taxes paid into the system.
Show me the money!
So hopefully that helps a bit in relieving some of the worry about taking money from the business. This topic leads to tax forecasting and its importance as well, because just because you're taking out a salary for a certain amount, the real important number is how much tax are you going to pay for the year. So some of those remaining funds in the business may be needed for tax purposes. So it's not wise to drain all the funds out. You're going to need to leave money in there for operating expenses. And then also you should have an idea of what your tax situation is going to look like before you distribute money out.
You had me at hello.
As always, if you have any feedback or questions, please let us know. There is a separate video just on the reasonable compensation issue. So I hope this video helped a little bit just on the pay topic for S corporations. Thanks for tuning in and stay tuned for more content from TaxCrunch.